Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Hello busy professionals and part-time option traders. Thank you for tuning into OptionGig. And in this session, I want to continue the series that we had started a while ago around option trade management. Like I've said time and again, this is a session that differentiates between a novice option trader and a seasoned option trader. Trade management is one area which will differentiate between people who lose money in option trades versus profitable option traders. So this is important and we have been doing series of this. Today it's a part 4. All right, so let's quickly jump into why we should manage trades. Because if you manage your trades, you can convert the losers into winners rather than just resigning our trades to the market and raising our hands and saying, I can't do anything about it and taking losses. We should actively manage our trades, because if we do that, we could convert the losers into winners. Having more winners on table also increases our confidence and keeps us in the game. Second reason is, if for some reason you're not able to convert it into winner, at least you will be able to reduce the loss without taking any additional risk. How about that? You haven't taken any additional risk, but you are still able to reduce the eventual amount of loss that goes in the trade. Why? Because you are able to actively manage the trade. Continuing on the recap, like I said, this is part number 4. So a quick overview of 3 techniques that we already learned. Technique number 1 was, hey, extend the duration of the trade, give yourself more time to be right. Your thesis was correct. You are still very strong about the direction of the stock that you have assumed. Your thesis might be correct, just that you need to give a little more time for your trade to play out and for probabilities to play out. So technique number 1 is to extend the duration. Technique number 2 is to roll up or down the unchallenged side. If you do not have an unchallenged side trade already available, you go and initiate an unchallenged side. Number 3 is to go inverted. Now, if you have not gone through 1, 2, and 3 yet, I would request you to stop right here and go through these 3 techniques. Go back to some of the previous episodes where I have talked about 1, 2, and all the 3 techniques, because each of the technique build upon the other one. So technique number 4 that we're gonna talk about today involves a good amount of understanding of all these 3 techniques. So stop here and review all the 3 techniques and then come back here and continue on this one. All right, so if you have decided to continue on it, I'm assuming that you are pretty much familiar with all the 3 techniques and ready to jump into technique number 4. All right, technique number 4, which I call is a potpourri. It's not really an entirely new technique in itself, but it's a mixture of using technique 1, 2, and 3. So one thing to note is that techniques 1, 2, 3 are not mutually exclusive. You can combine any of those techniques when you're trying to manage your trade. And that is what essentially technique number 4 is. Let's take an example. Say you have a short call that is being challenged. So step 1 is, you can try to create an unchallenged side. So you can create a short put. Then you can also roll up your short put, which is again technique number 2. But if it's still being challenged, then you roll out the trade to a further expiration period, which is technique number 1. So in this case, by creating an unchallenged side and then by rolling up the put side, you've given yourself more premium. You have collected a lot more premium. You have widened your break even, means you have reduced your risk and given yourself more chance to be correct. And then when you further rolled out the trade to a later expiration period, you got more time to be correct in that case. This is just a theory, so we gonna look into the real life example. And before I open my trading platform, I just want to give you a summary of what really happened in this particular real case that I had gone through in 2019. 2020 has just started, so I don't really have a case from 2020. So we're gonna look at a case from 2019. This is a trade that I had to manage multiple times, and I was able to convert, and because of trade management, I was able to convert a $700 loss to an $80 profit. $80 profit doesn't seem to be too big profit to celebrate, but converting a $700 loss to 80 profit means I was able to manage a swing of $780. And I think I was pretty happy to get out of this trade at a profit. I'll explain step by step of what I did, and then I can show you on the trading platform each of those trades. So first trade is on mid of June, on 14th of June, I sold a naked call on SMH. This is an ETF on semiconductor. On 14th of June, I sold a naked call with a strike price of 111, and the option trade is expiring on August, which is 16th August. When I sold this call, I collected $1.60 as a premium. Now the SMH was trading at that time at $102.41. So I had a pretty much good buffer on the call side, almost $9 buffer on the call side. But we never know where the stock is gonna go. So the stock continued to rise, and eventually when I had closed this trade on 31st of July, because that was just 2 weeks to August expiration, I was about to get into a time frame where the gamma risk would have been very high. So I wanted to close the trade. So eventually when I had closed the trade, this individual trade would have been closed at a loss of $708 because the stock price on 31st of July was $119.22. Remember, our short call was at $111, and now the stock is trading at $119.22. It is way in the money. So if I had just closed the trade, if I had not done anything, I would have been looking at the loss of $708. So now let's understand the steps that I did, which eventually reduced the loss and converted into profit. So I did not sit and wait while SMH was going against me. So I initiated this short call on 14th of June. And then on 19th of June, I also sold a naked put at a strike price of 95, same expiration period of August, same number of contracts, which is just one contract. Instead of just having a naked call, I also took the other side, sold a naked put at 95 strike price and collected $1.26 as additional premium. I opened this trade on 19th of January because the stock had moved up from 102 to $106.49. So now when I did that, my new position in SMH is a strangle with the short put at 95 and the short call at $111. SMH continued to go against us. it continued its rise. So when it rose to $113.22, remember my initial trade when I did on a short call, SMH was $102.41. Now it has actually challenged, it has gone beyond my call strike, and now the SMH is at $113.22. So what we did, we rolled up our short put. So the short put that I had was at 95 strike price. I rolled up the short put from 95 to 105. Same expiration period. I did not change it. I just rolled up the put. Same number of contracts, just one contract. So no additional risk on it. But when I rolled up the put, I was able to collect additional 67 cents. So now if you add all the premium that I've collected till date, the initial trade short call, I had $1.60. Then I added a short put. I collected $1.26. Then I rolled up the short put. I collected additional 67 cents. Now till date, my total premium is $3.53. Means my break even has been widened further. Now, unfortunately, SMH still not cooperating, and it continued to rise. And when it was around $118 on 22nd of July, I did another trade management. I rolled up the unchallenged side, which is my put side. I rolled it up from 105 put to 111 put. Same expiration period, August, just one contract, so no additional risk. But now, when I did this, now my short put is at $111, short call is at $111. So now we have converted our strangle to a straddle. So when I rolled up the put from $105 to $111, I collected additional premium of 55 cents. Now, that means my total premium till date is $4.08. Now, when I did this trade, SMH was trading at $118.44. So my short call is at $111. Stock is trading at $118.44. And total premium that I have collected till date is $4.08. Now it's 22nd of July. And I'm getting a little scared because August expiration is 16th of August. So we hardly have 3 weeks for August expiration. So what we have to do when we are closer to 2 weeks before expiration period, I roll out the complete trade. So now I'm mixing the two techniques. Till now, I have been rolling up my unchallenged side, but on 31st of July, I rolled out the complete trade from August to September expiration. Means I closed the straddle 111 call and 111 put of August expiration, and I opened a new straddle for September expiration, same strikes, same number of contracts, so no additional risk. Just I gave myself another additional 30 days to be right. But when I rolled this contract from August expiration to September expiration, I collected a whopping $2.68 as an additional premium. So if we add all the premium that we have collected till date, the total premium is $6.76. Now, when I did this trade, the stock was trading at $119.22. Means it's not too far away from our break even. So our short call is at $111. Total premium we have collected is $6.76. Means our break even is $117.76. On 3rd of September, the stock came down. It was around $112, even though there was a lot of extrinsic value left in it. But I was able to close this straddle for $5.97. Finally, I was able to close it for profit of $79, close to $80. Could I have waited further till expiration to collect more premium? I could have. But I really wanted to get out of this trade because I've been defending this trade for 2 months. The moment I saw that I have converted a $700 loss into $80 profit, I think I was pretty satisfied with it and I closed the trade. So this is one example how we can use multiple techniques combine with each other and not give up, but try to manage the trade, and you will be able to convert sometimes a losing trade into a profitable trade. So now let's jump on to our Thinkorswim platform and I can show you the details of how the trades were done. Here I have my Thinkorswim platform open where I have gone back from June of 2019 till September of 2019 because that's where I have this SMH trade. So let's look into it. The first one that we opened on 14th of June, 111 call, and we sold it for $1.60. This particular trade I also closed my June one, but for now we're not looking at what I did in the June expiration trade. But let's assume this is my first opening trade. Expiration date is 16th of August 2019. Premium collected is $1.60. Now on 19th of June, I added additional $95 put, collected a premium of $1.26. On 12th of July, we rolled 95 put to 105 put, means I closed 95, open 105 put, collected additional $67 as a credit. Then on 22nd of July, did the same thing, rolled the unchallenged side from 105 put to 111 put, collected additional 55 cents as a credit. Now on 31st of July, just close to 2 weeks before expiration of August trade, I rolled out my complete straddle. So $111 put, I closed for August expiration, rolled it out to $111 put for September expiration. Also, same thing for a call. I closed August call, opened September call. Now, when we did this trade, we collected $2.68 as a premium. Then eventually, I was able to close both $111 call and $111 put on 3rd of September for a debit of $5.97. Now, if we really look into all of our credits and the debits, we are eventually ending it at $79 as a profit. So that's all about technique number 4, which is nothing but a combination of all the previous techniques. And also I hope this real life example also helps you in understanding how exactly you have to do in your platform and that the thing really works. It is not just a theory. These things do work in the market. As always, if you have any questions, do let me know by dropping a note to OptionGig@gmail.com. And I have a request that if you are watching it on YouTube, please subscribe to it and maybe leave some comments. If you are listening it on a podcast, please give me a good rating. That's the only way. Your subscription on a YouTube and a rating on a podcast is the only way for others to find this channel. And I really want to reach out to as many people as possible. That also keeps me motivated. Also, let me know if you want me to cover any other topic. I will be very happy to create another session for you. Thank you very much and happy trading. please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.